AAR Corp just reported net income of $187.7 million for fiscal 2026. The year before, it earned $12.5 million. That is 15 times more profit. Revenue over the same period grew 19%. 19% more revenue does not produce 15 times the profit. So what did? Here is fiscal 2026. Revenue of $3.3 billion, up 19% from $2.78 billion. Net income of $187.7 million against $12.5 million a year ago. And diluted earnings per share of $4.86, up from 35 cents. These are audited, filed numbers. The question is, what produced them? 5 years of net income tells you why that comparison is strange. $78.7 million in fiscal 2022, $90.2 million in 2023, then $46.3 million, then $12.5 million, and then $187.7. Earnings did not compound. They collapsed for 2 years and then spiked. When a company grows 15 times off a base, the first thing to check is the base. Fiscal 2025 carried a charge that fiscal 2026 did not. In 2019, AAR self-reported possible violations of the Foreign Corrupt Practices Act, involving transactions in Nepal and South Africa. On December 19, 2024, it settled with the Department of Justice and the SEC and recognized a charge of $55.6 million. That one item is most of why selling, general, and administrative expense barely moved this year, rising just $1.6 million, while revenue grew 19%. Here is the whole move from $38.9 million of pre-tax income in fiscal 2025 to $245.9 million in fiscal 2026. The 4 operating segments contributed $43 million of it. Corporate costs falling contributed $49.6 million. One-off gains and losses flipping contributed $113.1 million. Interest and other added $1.3, which means about 79% of the increase came from somewhere other than the segments earning more. The tax line finished the job. AAR's effective tax rate was 67.9% in fiscal 2025 and 23.7% in fiscal 2026. The filing says the drop is primarily because that $55.6 million settlement charge was non-deductible, so it produced no tax benefit at all. $26.4 million of tax on $38.9 million of pre-tax income left $12.5 million. That small denominator is what makes the multiple look like 15 times. Now the part that is the business. Segment operating income rose 15.1%, from $284.5 million to $327.5 million. That is slower than 19% revenue growth. And the combined segment margin actually fell, from 10.2% to 9.9%. Parts supply went from 14.3% to 12.5%. Repair, engineering, and software went from 9% to 7.8%. Legacy commercial programs earned nothing at all. Only government solutions improved, from 7.1% to 11.3%, on barely any sales growth. The one-off gains deserve a closer look. $29.5 million of fiscal 2026 earnings is a bargain purchase gain on the Hayco Americas acquisition. AAR paid $78 million for a business whose net assets had valued at $107.5 million and booked the difference as income. Its stated reason is that the seller was highly motivated to divest. Another $9.8 million came from selling the old headquarters building in Wooddale for $26 million. Both are real. Neither is a customer buying a part. Then follow the cash. Operating cash flow was $98.7 million against $187.7 million of reported net income. Take out $36.6 million of property and equipment spending and $28.8 million of hangar expansion, and roughly $33 million of free cash flow is left. Inventories alone consume $69 million. Inventory on the balance sheet is $979 million against $3.3 billion of revenue. So every extra dollar of revenue here costs about 30 cents of cash before it earns anything. So what is it worth? At about $136.57 a share per investing.com in July, the market capitalization is near $5.37 billion, roughly 17.7 times EBITDA, a discounted cash flow that charges 30 cents of working capital for every extra dollar of revenue. Because that is what the cash flow statement shows, gives about $37 a share in a bear case, 66 in a base case, and 112 in a bull case. All three sit below today's price. To justify that price on 6% revenue growth, you would need a consolidated operating margin near 17%, higher than any segment earns today. Implied value under stated assumptions, not a price target. Put both years on the same footing and the picture is calmer. Add back the $72.4 million divestiture loss and the $55.6 million settlement charge to fiscal 2025, and take the $40.7 million of gains out of fiscal 2026, and pre-tax income went from $166.9 million to $205.2 million. That is growth of about 23% on 19% revenue growth. Modest operating leverage. A good year, not a 15-bagger. This entire analysis was built using RoboSystems, a platform that gives you direct access to structured SEC filing data for every public company. Revenue, earnings, balance sheet, cash flow, segment breakdowns, all queryable, all from the original XBRL filings. If you want to do your own deep dives like this one, head to robosystems.ai, link in the description.